Hey traders and investors, it's Serge Berger here. I got a lot of questions over the weekend and the second half of last week about the S&P 500. What are we going to do now that it's basically ripped the face off of just every single bear and quite frankly even the bulls who got a little bit scared right here at the mid-October lows? For the very active trader, I think this might have been okay. For those more with a swing trading attitude, such as myself, to be very fair, it's been a very, very difficult market with subscribers and for all the portfolios that I manage. No, we didn't sell into this dip. We bought this dip. So far, though, what I've done is I actually legged into short positions too early, to be very honest with you. So let's have a look at what's going on here. If you are considering buying the breakout here, right now, I do think you have a very low risk reward probability environment to really make any money. If you look at this kind of move historically, I've pointed this out time and time again, and we'll look at volatility again as well. I'm kind of just regurgitating some of the stuff that I've said in the past, but it's really important to understand every time you've had a low volatility environment and you get a break like this, we've had a pretty good trend break on the logarithmic charts here at the October lows. And in other words, we made a lower low, okay, compared to the August lows. I know we matched the April lows, but we went a lower low below the August lows and now made a higher high, all literally within a couple, in like say, let's say 3 weeks. That is not what sustainable rallies are made of. So in other words, there's an extremely high likelihood this will at some point lead to another significant move down. Whether that comes before now and year end, or before a Santa Claus rally, or it doesn't come until the new year, I don't know. But I do think some sort of a pullback here is almost imminent. Now, I've been saying this for some time, for about a week and a half or so. Um, but I continue to think that shorting the market here needs to be done on a confirmed weakness day, and we haven't really had any confirmed weakness day. We had a semi-weak day here on the 22nd of October, but that was not followed through at all. In fact, the next day we made a higher high. So we really need to see some sort of confirmation. We've had absolutely no confirmation that this is letting up. The only confirmation we are starting to see, where and this is where you have to look at volatility. If you look at the VIX, and I'm just giving you a bit of a cross-asset analysis because I really do think it's very much warranted here at this juncture, and this really what's been a part of the probably one of the nastiest risk reversal or risk reversal days markets I've ever seen. Pain trades, I guess, is the word that comes to mind. But the VIX continues to make a series of higher lows. Okay, even though we're now today, or as of recording, is kind of dipping a little bit below where we should, but we're still recording a series of higher lows until we make an a fresh new lower low, or at least revisit the July lows. The volatility, implied volatility, is not confirming the breakout in the S&P 500. We can look at other things like, for example, the XLY, which is a consumer discretionary stocks last week lagged. Okay, unless they start breaking higher, this too is not exactly very much inspiring, confidence inspiring. TLT, this is bonds. Okay, bonds are actually higher as of last Friday's jobs report. They're not. They didn't make a lower low, which would have been what you'd want to see when the stock market makes a higher high. So if you look at it that way, things here do look a little bit frothy, and I would very much caution against chasing this market higher in the near term. And beyond that, we need to measure how much any dip goes. Hope this makes sense. If you obviously got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader, and I'll see you in the next video.